do you think that in that context, trying to reduce our taxes by say 10%, as we discussed in the maximum potential, knowing this quadrant and applying that, do you think 10% is realistic for most?
Hello, Eric.
Hello, good morning, Mike.
Just to cast a dark shadow over today's episode, we're going to talk about taxes.
Well, it's part of life, so we may as well get into it, especially on
Yeah,
the heels
yeah,
of maximum potential, right? It's one of those big rocks. So
yeah,
here we go. Yeah.
yeah, yeah. Well, the other thing is too is that we don't want, it is a dark shadow, I think, for lots of people, but really we want to kind of flip the script on that, right? We want to say, hey,
Yeah.
it's reality. It's like anything, right? It's reality. What are we going to do about it? We can sit and
Yeah.
complain about it, but we really want to do something about it. And like you pointed out from the maximum potential chapter, we're really trying to outline for people the big rocks that affect wealth accumulation and taxes, are really our greatest expense. At the start of the book, we kind of go through all the different taxes that we're potentially exposed to, and it's mind-boggling when you think about it, right?
Yeah, and I think Canada is not the only country. I mean, a lot of
Mm-hmm.
countries have a lot of taxes, and some countries have even more taxes than in Canada, right?
Mm-hmm. Mm-hmm.
Yeah,
Yeah.
but there's a lot of them. Yeah, there's a lot of them. Payroll tax, corporate tax, personal tax.
Yeah. Keep listing them off. You got them there. Keep going.
Oh, gift tax,
Yeah.
resort tax, fuel tax.
Yeah.
You mentioned the carbon tax,
Yeah.
sales tax,
Yeah.
GST, it goes on and on. There's probably many more pages we could fill up with these taxes,
Yeah.
and many of them are out of sight too.
Yo, oh
Yeah,
yeah, for sure, for sure, and we'll talk
yeah,
about that a bit more. But the thing is that again, we kind of understand why taxes exist, for the most part, right? Because we all live in, communities and we live together, and services and supplies and things like that need to be organized. And obviously, we're not going to pay for those things at individual level, so we've organized governments and different community bodies to take care of those things for us. And in order to do it, we need to collect, money from everyone to chip in for those things, and it's it's got that name of taxes. But we want to make sure again that we're not today. We're not going to talk so much about the morality of taxes, right? We're here
yeah.
really
Let's
just to
stay
talk.
pragmatic. Yeah,
Yeah, yeah, yeah. Really talk about how people can understand taxes and maybe do what they can to really optimize their personal situation with regards to taxation.
like in the maximum potential, we talked about, okay, what if we could shave down that tax variable
Mm-hmm.
by say 10%,
Mm-hmm.
something like that.
Yep.
So, us going through this chapter today, if we can keep that in mind, maybe to make
Mm-hmm.
suggestions,
Mm-hmm.
or these are kind of maybe notes to go further for people on an individual basis and explore what they can do with their tax professional, right?
Yeah, yeah, no, for sure. The
Yeah.
idea here is basically to optimize your situation. And if you go to the kind of the taxpayer charter of rights for Canada, it says in there clearly that everyone has the right to pay no more tax than required by law. So you are very justified to only pay the amount of tax that you're required to pay, right? And that requires, some understanding, but most of the time it's going to require the help of a professional. And
Yeah.
we're here to give people some information and give them, some basis to feel empowered to, again, ask those questions and really kind of turn their tax situation in their favor.
Mike, I don't know if this is a fair question at this time, but I think a lot of the viewers would probably ask a question like this in the sense that do all accountants do they perform equally? I mean, from the layman's terms, you think, okay, it's a rule book, everybody follows it, it would be the same for everybody. But are there quality differences between one tax advisor and another?
Yes, there are. Yeah. It's kind of like anything. Like we'd say, hey, are there quality differences between, you know, different financial advisors, right? And you're
Hmm.
going to find that, right? And I guess there's a couple of points here that are really important, and it's a good question to ask, Eric. So, um, the first point is to really understand that taxes are law, right? Like tax rules and regulations are generally law, right? So they're subject to interpretation. And so, so
Yeah,
really,
that's important.
they are subject to interpretation, right? And there's there's gonna be a general consensus about what you can do and what you can't do, but there are going to be fuzzy areas, right? And that's there's a whole industry out there of tax specialists that operate on the margins, right? Just like anywhere, right?
Mhm. Yeah,
But that's the first thing, is to understand it's basically law. And the other point, as we talk a little bit later in the chapter, it's a rule book of really steering people towards activities that the government wants people to do, right? And so that's why in certain situations like, real estate, you can depreciate your building because they want you to be able to deduct a certain amount of the cost related to your building, because that helps you with taxes in the early years when you're putting a major capital investment into, let's say, real estate, right? So there
mhm,
are, so it's a rule book, right? And it's law, right? But the other thing
yeah,
is too, is that, we can't forget, and we make this point a lot in the book and we can't overstate it, is how we as humans develop trust. And so usually, financial
yeah,
professionals, and I don't think it's all that different with tax professionals or accountants, is there's probably generally 2 degrees of separation between who you choose, which means you're asking, you're either using a friend or a friend of a friend. Like that's how you're getting the referral, and
yeah,
that's not always the best way to do it. No matter who you're talking to about kind of what you require, is to be able to ask those questions and be able to do to be able to assess the expertise of this person, right? And
yeah,
and it's hard. It is hard, but the thing is that overriding that human nature thing to say, hey, well, this is my best friend and this is his accountant, so therefore he must be a great accountant. Um,
yeah. That's
yeah,
not terribly objective. Yeah,
yeah. Well,
no.
no, and I've seen that one. I've seen that one go astray. Like I had a situation just recently where, this couple has used these accountants for 20 years, but they've built a very significant real estate portfolio, and they're doing some big things, and there's some interpretations around some rules, and the information that they've been told is just frankly wrong,
Mm.
and they were
Wow.
relying on that, and now we can actually do something to restructure the situation to make sure that they can take advantage of these specific rules. But again, that's what maybe we'll talk a little bit more, is that because of governments and the need to tax, and for all the different things that are going on in the world, they're being more and more onerous of the rules and the disclosures, and it's really having an impact on accountants. And unless you have a very basic, straightforward situation, uh, you know the amount of complexity that's out there with regards to the tax rules now, you need to really do your work to find someone who is competent and can do the job for you, right?
Yeah,
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 yeah.
and more so than ever before, right?
Oh yeah.
Um, yeah, Mike, we looked at a chart together on this, the trend of what's happened with taxation in Canada.
Mm-hmm.
You want to maybe bring that up because I think it makes it very relevant that not only is our taxes this big rock in our maximum potential, but understanding what the general trend is quite important.
Mm-hmm. Yeah.
Um,
Trying to make this a little bit bigger here.
yeah, no worries.
Whoa.
Mm,
Well, that kind of
perfect,
worked.
almost
Yeah.
perfect.
So what this is showing, this is basically the light bar that everyone can see there. I don't know if you can see my mouse, but the light bar uh, is 2014, and we're talking to 2024. And if I just bring this back out for a second, we're starting with BC and we're going all the way across to none of it, I guess, right?
Mhm,
And so
mhm.
so some of the ones, here, so it was BC, Alberta, Saskatchewan. So we're really going from west, it looks like, to east here. Okay, so west to
And
east.
then a little bit north.
Yeah, then a little bit north, right? So as you can
Yeah.
see, right, the rates in BC started off at, in 2014, the highest marginal rate is at 45. Well, now we're at 53. Alberta, 48, Saskatchewan 47, and then just look at, and this 50% magic number has really been thought of over time as being kind of the place where people start to limit their activity because they don't see the benefit of continuing um, to work as hard, right? Because
Yeah.
they don't see as much, coming back to them, right? They feel like they're kind of working for the government, right? So,
I've
um,
had a lot of clients express that same concern, Mike,
yeah,
and where
yeah.
they're getting demotivated by that
hmm
tax rate. Yeah.
And we have to be very clear that this is personal slash corporate tax. Like the personal and the
Yeah.
corporate system are somewhat integrated, right? So
Hmm.
it's okay to look at kind of these rates, and that doesn't factor in a whole bunch of those other things that we've talked about, like GST and
Yeah.
carbon
Those
tax
additional
and the rest of it,
taxes
right?
that you
So
spend away. Yeah.
yeah. So, and these are, the people at the higher ends of the income spectrum, right? And,
Yeah.
and we've kind of taken the position as a society that, those who make more are going to pay more tax, which, we think is fair and that's okay, right?
Yeah.
But the numbers are staggering, and it's yeah, it's it's an interesting
A
kind of
lot.
thought experiment
Yeah.
for sure. Yeah. So
Yeah.
what we do at the start of the chapter, Eric, is we kind of do a little interesting exercise to give people some context. So we take
Yeah.
$100 and we say, hey, if we compound it at 10% over 105 years, which was meant to reflect when Canada first started implementing an income tax in Canada. Um,
Yeah. Some
and
time ago.
yeah, some time ago, and we we kind of did the math, and we said, geez, that $100 over that 105-year period at 10% would equal $2 million, right? And so that, I don't know if most people would be surprised by that. I think most people would think it was a big number because we're used to a lot of these exercises of showing compounding and how it's
Yeah.
the one of the what do they say, the one of the
Uh,
greatest powers.
Natural wonders.
Yeah,
Yeah.
there you go. Yeah, yeah, you got it.
Yeah.
Yeah,
Yeah.
yeah. And but then we show, okay, well, what happens when we implement a 50% tax, and what do you think most people would say the answer is, Eric? What do you think that would happen to that $2 million if we instituted a 50% tax along the way?
People would probably imagine would be half of that. Yeah.
Yeah,
That would be deducted.
yeah,
So
yeah.
you'd have after all these years only a million instead
Yeah,
of 2 million.
yeah, yeah.
Yeah.
Which most people say, yeah, that's not a terrible result, I guess, and because I think it ties into that context that we just talked about on the chart, right? Well, 50%,
Exactly.
you
It's
know.
contextual. People can
Yeah,
understand it.
yeah. And
Yeah.
when people kind of
Yeah.
talk about things, hey, let's split the bill, 50% for some reason, right? When you're sharing, it feels okay. It doesn't feel great, but it feels okay, right? Well,
That's right.
implementing that 50% tax along the way would reduce that $2 million number to just below $16,000.
Which is mind-boggling. The first
Yeah.
time I saw that spreadsheet, I couldn't
Yeah.
believe it.
Yeah.
Yeah.
Yeah. Yeah. And,
Yeah.
the thing is that, what we point out is that, the tax isn't paid at the end. If it was paid at the end, yes, you'd have $1 million, but it's paid along the way. And so it's the
That's
ability of
right.
that income to continue to grow, which really limits. And so I think um, that really focuses people on the impact of taxation and the impact that it can have on your wealth accumulation journey, right? Because when we're going through maximum potential and we're
Yeah.
showing, hey, we're going to have a 10% reduction in your taxes, right? So we go from 40% to 36%. The jump is huge.
It's huge. Yeah. And we
Yeah,
recapture a lot of that lost opportunity costs, right?
right.
That this whole series of deductions along the way
Mm-hmm. Mm-hmm.
reduces a lot. Yeah.
Yeah. No, for
Yeah.
sure. Yeah. So,
Oh,
go ahead.
so now that we have the context of how much taxes can bite us,
Yeah.
we saw that, of course, in the maximum potential chapter. Um, what about Mike? Everybody thinks, okay, well, if I get a registered account like a RSP, a 401k, a TFSA, or a Roth IRA, all of a
Hmm.
sudden I'm going to be better off. I'm going to, save on taxes. I'm going to get a refund, perhaps.
Hmm.
How do you put that into context with what we're just talking about? Is that really the solution that we are made to believe it is, or is there more to be desired?
Yeah, no, it's a good question, Eric, and we have lots of lots of information, two spots in the book where we talk a little bit about the subject about registered plans. And when we talk about registered plans, we're really talking about things like RESPs, which is Registered Education Savings Plan, that generally people use to save for school for their kids. Tax-free
Hmm.
savings account, right, which is another registered plan. And obviously the RSP, which is a very popular registered account, and there's others. And and the RSP has been very popular for lots of reasons. Many people say it was really the replacement for the death of pensions. For the death of
Hmm.
company provided pensions. And but there is a lot of misunderstanding around how it works, right? And I think that's
Yeah.
that's really where we point to in this chapter. I personally try to be agnostic around tools. So if
Hmm.
someone will save money and put their money in an RSP, and that's the way that they'll start to build for the future, then high five, right? You
Totally.
know,
Totally.
yeah,
Yeah.
it's our
I
job to
totally
help.
agree.
Yeah, to help people on their journey, right? We just want people to
Yeah.
understand the tools that they're using, right? And lots of people think that there is a tax refund, and honestly, it took me something until I got into to this industry to say, oh, that's really not a tax refund, right? And
Yeah.
and we pointed out an example, um, and these plans are pre-tax, right? The government gives
Yeah.
you whatever tax you might have paid on that money back, so that these plans are pre-tax, right? And it's just like a pension that you receive from your employer. 100% of that pension income is going to be taxed, and in the future, 100% of your RSP is going to be taxed, right? Whether it's an
Yeah.
RSP or whether it's converted to a RIF when you turn 71. And but lots of people, sometimes they use it to manage. So let's just say someone earns, income that can be variable, right? And so they use it, in a year that they have a high income, right? And they get the amount of tax that's returned to them is higher, right, than that might have been returned to them in lower income.
Yeah.
So maybe there are ways to look at that, but really, at the end of the day, all the tax, refund, the bunny ears refund, is reduces your investment in the plan. So if you pay tax at a 50% rate, and you put $10,000 into an RSP, 5,000 of it's yours, and 5,000 of it is the government's. It's literally
Hmm.
the government's contribution to the plan, right?
Yeah.
And
Yeah.
that's the way to look at it, right? Um, and they earn the returns like you earn returns, and if that money goes down, well, their money goes down. But at the end of the day, the government has made a contribution towards that plan,
Yeah.
through the returning of your taxes, and most people don't look at it that way, and we see it all the time where and again, it's the it's the hidden in
Yeah.
plain sight aspect of taxes that really hinder us. And because this one that's sitting there is when people say, hey, I've got $1 million in my RSP. Well, yeah, you got $1 million in your RSP, but also if we were doing a true balance sheet, we'd have to do an estimate of what taxes you'll pay on that in the future, right? You
That's
might
right.
have a three, 400, depending on how long it takes you to wind the RSP down and what rate you pay on the income. You might have a $300,000-400,000 liability, but I've never seen someone's net worth where they have estimated the liability associated with their RSP on their net worth statement. Nobody.
Interesting, isn't that?
Yeah, but it's there, right? It's there. And so we just want people to understand the fact that um,
Yeah.
it's their net money that they are investing in that plan. It's the net money, right? It's not the gross amount, right? And then over time, sure, there's ways that you can benefit, right? And ultimately, you benefit if your income is lower in retirement because then you're going to pay less tax, right? And so you're going to get to keep most of that money. But then another conversation we have with people is like, hey, do you really want to have less money in retirement?
Yeah. What is that positive tax differential worth for you? What's the real benefit, or what's
Yeah,
the real
yeah,
cost?
yeah,
Yeah.
yeah. Like most of
No,
us are
no,
not
no.
most of us are not planning for less money in retirement, right?
No, it's not. No.
Certainly not, right?
Yeah.
So yeah, so it's okay. It's fine to use that tool. That's fine. That's okay. And um, but just understand what it
If I
is.
can add to that too,
Yeah,
we talk about death and taxes, but just I think on the heels of that,
yeah.
if somebody passed away right now
Oh yeah.
with $1 million in their RSP, what would be the tax hit with that, Mike?
Well, generally speaking, like most things, you can leave the plan to your spouse, right? Or there are some provisions for certain infirm individuals, relatives, things like that. But generally speaking, most assets transfer tax free between spouses. I think all assets, for the most part, transfer tax free between spouses. Um, but if it was on second death, that it would be subject to your highest marginal rate because all that income comes in uh,
Yeah,
on that
all at
terminal return
once,
all
right?
at once. Yeah,
Yeah,
yeah, yeah,
yeah.
yeah. So
Which by nature would be the highest. Yeah,
yeah, so when we're doing
yeah,
planning, we really plan for people to run off that asset early, right? As
yeah.
part of our, when we're in the distribution phase, we're running off the RSPs and RIFs pretty early, right? We don't want
Yeah.
that liability to be carried into the future, and the impact on your highest marginal tax rates is not great planning.
No, no. And I guess that's also why the TFSA is so popular too, right? A lot of people are looking at that going, okay, the net, if I'm going to deal with the net and they understand that, let's put
Yeah.
the net somewhere else.
Yeah, so when we're talking about TFSAs, we really have said in the book that they're pretty much a no-brainer. That, given the fact that you're in a no tax environment, why would you not want to have money there? And we tell people to move it from a non-registered account into, your TFSA to, kind of reduce the amount of tax that you're going to pay on that account. But the thing is that with the amount of contributions, the conservatives, we're thinking about ramping up, some of the contributions like over, kind of $10,000 a year, and now we're talking. But that
Yeah.
was that was repealed by our friends,
8 years ago. Yeah.
by our friends that are currently in government. And so there's just it can add up over time, but it's not as much of a game changer as it could be, I guess, right? And I
Yeah.
guess the other thing to think about with TFSAs is that they're a little bit cumbersome because of how the rules work. You
Yeah.
can't just pull money from your TFSA and put it back in, pull and put it back in, because what happens is that um, any withdrawals from your TFSA aren't added back to your TFSA contribution room until January 1st of the next year. So if
That's right.
you're removing and contributing, removing, then you're going to be over contributing to your plan, and you're going to have penalty taxes.
Yeah. And
You
they're
know,
they're quite steep, those penalties.
yeah,
But it brings forth a point for me is that my suggestion would be try to avoid doing that because you're kind of really interrupting your compounding of interest anyway. You're kind of defeating the purpose of having this tax-free growth really maximize itself for you.
hmm
Would you agree?
yeah, no, for sure, right? Like some people use it as an emergency fund, right?
Sure.
You
Yeah.
know, and so
Yeah.
yeah, no, for sure. And then there's I guess the other thing, and there have been people that have really done well inside of their TFSAs because what they've used their TFSA is almost like, you know, a way to invest into high risk investments. And, you know, so if you hit a home run on, let's say, a Spotify or an Apple or a Google or something like that, you know, you could have millions inside of a TFSA, right?
Totally.
Which
Yeah.
is another thing. But that's, you know, that's generally not the subject of our book or what we're up to.
That's an outlier situation for sure. Yeah.
Yeah, yeah, yeah. So, but yeah, it's an interesting tool, definitely that can be used.
Yeah. Right on. So when we go from those registered plans, we obviously back to the RSP, we realize that we put up all the money, we take all the risk, we pay all the fees, and then we divide it later with the government. How fun is that? Anyway, moving on,
Yeah,
right? We
yeah.
we talk about a few other things. We talk about death and taxes. We briefly touched on that, Mike.
Hmm.
Do you want to add anything to that? Any significance that you think that people should be a little bit more aware of than they might be?
Yeah, I think you know. I think the thing that people don't kind of realize is that there's been a lot of discussion around the fact that there are no estate taxes in Canada, and they're correct. There are generally no estate taxes in Canada. However, the reason that there are no estate taxes is because you're deemed to dispose all of your assets the minute before you pass away. So, so you know,
It's really a
really,
play on words,
it
really.
is. It is. Right. You know,
Yeah,
and so, um, again, we got to be careful with some of these statements, right? When we're, you know, when we're making comparisons, right? Like, for
yeah.
better or for worse, you know, we love to make comparisons as humans, and you know, as a way to judge things and the rest of it. But some of the comparisons are just not relevant, right?
So yeah, the next three things are, I was going to suggest lead into tax on personal property, financial assets, real estate briefly on these three things,
Okay.
if you want. Yeah.
Okay. Start.
Okay, that makes a lot of sense, Mike. So there's an estate tax after all, even
Yeah.
though it's not
Yeah.
called
Yeah. There
that.
is. Yeah. There is. Yeah.
Yeah. So there's the book gets into a couple other things that I think are worthwhile mentioning here. A tax on personal property,
Hmm.
tax on financial assets, and tax on real estate. Do you want to comment briefly on each of those?
Yeah, I think what we were trying to do in the
Mm.
book is just give people a little bit of information around taxes and how it works, right? Just so they can, you know, because we need to feel empowered when we have some information. So the
For
chapter was
sure.
not meant to be a complete,
No,
you know, a complete guide to how to file your taxes after you pass away. Right. But we talked about some areas that people don't understand, like taxes on personal property, um, you know, and you know the fact that personal property is generally taxed is lots of times it's just missed, or it's not included on returns. And you know the way that our system works in Canada, it is a self-assessment system, and so if the
yeah,
government comes and audits you, and then you had a, you know, you had a Van Gogh stuffed in the basement, and and they never found it, then okay, but that's not how the system's supposed to work, right? You know,
yeah,
it's a self-assessment system, and so it's just really for information. Um, you know, financial assets are, you know, we're really used to seeing how those are taxed because there's a mechanism that really ensures that the government, you know, kind of gets their fair share. You know, mutual funds and the rest of it have to distribute, or there's a tax that they get paid, right? So they have to pay,
yeah,
right? So they distribute.
yeah,
So all those get, you know, listed on slips. You know, really, if you want to start to defer or manage your tax exposures on financial assets, you need to get into some individual positions, right, where you can accumulate some capital gains, and maybe you can, you know, because capital gains are obviously taxed at half, hopefully for a lot longer. They've been talking about repealing that, but also
yeah,
it just lets you, you know, defer, right? Because if you hold it inside of another structure, they're going to have to distribute, right? So
yeah. They'll have to do
um,
market.
yeah. And then we talk about real estate, which is a great asset that lots of people like to hold, and there's incentives in that to allow you to depreciate your building and the rest of it, like I think we talked about a little bit earlier. However, there's other things that, when you sell the real estate down the road, all that tax depreciation that you claimed has to be repaid, right? But the
Yeah.
fortunate thing is that at that point in time, you should have the cash in your jeans because you've sold the property. So, hopefully you'll have the
Thank
cash
you
to deal
very
with the
much.
tax, right? Yeah, so we talk about
Hmm.
some different assets and just, kind of let people kind of understand, how different assets are taxed and get some information. Because really what we're trying to do is we're trying to, break down barriers, right? We're trying to break down walls for people, right? Is really
Yeah.
what we're trying to do, I think, in those areas.
Yeah, I would say we're increasing awareness, increasing empowerment, increasing the ability to ask questions and be
Hmm.
pragmatic, less emotional about it, perhaps.
Yeah, yeah,
You know?
yeah,
Yeah.
yeah, yeah.
Yeah. Um, we mentioned sort of towards the end in the chapter, Mike, this quadrant, the discussion about, reading Rich Dad, Poor Dad,
Hmm. Hmm.
and, his accountant as well. Do you want
Yeah.
to comment on that briefly?
Yeah, Tom Wheelwright is just an amazing guy. Like if anybody ever gets a chance to see that guy talk, just
Yeah.
that guy loves taxes, right? And very
Yeah.
ethical, very high integrity guy. And again, he's built a wonderful practice at just empowering people around taxes. And it's no surprise to me that he's Kiyosaki's uh, Rich Dad Poor Dad fame. He's his accountant, and so they've kind of have this thing called the cash flow quadrant, which really gives people a bit of a roadmap in how to move. In order to reduce your taxes. And so inside the book, we kind of talk about um, moving from the. You know what? I might be able to pull it up here, Eric. Just give me a
Perfect.
second here. Let me see if I can pull it up.
Yeah, I mean, to add to that, it's basically reframing your state of mind around taxes and about operating your financial picture to more of a business person, which we kind of get into really later in the book as well.
Yeah, I'm just gonna go to images here. Um, yeah, so I'm just gonna just pick one here. Here we go. I'm just gonna share. This might
Hmm.
look a little bit funny,
Thank you.
but that's okay.
That's okay.
Yeah, so right here we're talking about, and you can see how popular his book's been, right? Like all the different images below
Very.
with the cash flow quadrant. But really, what he's talking about here is E is for employee, S is for self-employed or a small business, B is for a business owner, and I is an investor. And so, really, what he talks about is moving from being an employee to an investor and moving from a self-employed or a small business to a big business or a business owner, right? And
Yeah.
when he talks about rates, it's really compelling, because they're saying that employees, average rates can be 30 to 40%. Well, as an investor, because you have tax shields around things like real estate and things like that, you can actually reduce your tax rate to near zero in certain situations, right? Being self-employed, actually your tax rates are higher, up to 60%, because you're paying the employer's portion of certain taxes like Canada Pension Plan, employment insurance, right? If you have employees, and so that increases the amount of cost associated with you. But versus moving towards being a business owner, an incorporated business owner, you can actually lower your rates down to in Alberta, first 500,000 is under 10%. And then
Yeah.
above that, it's like 23%, right? Which is significant, right? And so,
Yeah.
um, so the conversation in there really around the cash flow quadrant is that point that we kind of are trying to make inside of our maximum potential video is that, hey, meet with your accountant and start learning about taxes and see how you can start moving towards those places where you can actually get some tax efficiency. right? In
Yeah.
terms of what you're doing, right? And yeah, that was a wonderful point that that he brought up, which really solidified it in my mind, and hopefully our readers will enjoy it too.
Like, do you think that in that context, trying to reduce our taxes by, say, 10%, as we discussed in the maximum potential, knowing this quadrant and applying that, do you think 10% is realistic for most?
I do, I do,
Yeah.
yeah,
Perfect.
yeah,
Yeah.
yeah. Because there's lots of ways where again, if you can develop a side hustle, we talk about that in the book a little bit around
Hmm.
this gig economy and
Yeah.
and there's lots of things you can do online. Well, okay, if you're doing things online and you're earning some revenue, then you can deduct maybe some home office expenses, your computer, different other things, right? Where, um, and that will give you some tax efficiency, right?
Yeah.
Um,
Right on.
right. So
Yeah.
yes, I
That's
do.
that's what's powerful about that. Yeah.
I think most like the good accountants for sure will reduce your your uh, your taxes by 10% for sure. Yeah. But
That's great news.
yeah,
Great news.
yeah.
I guess to finish up with the chapter, we talk about the cumulative effect of taxes. Do you want to talk about that a little bit?
The cumulative effect in what context, Eric?
Well, just I guess first of all, I think there would be an aspect of if you don't pay attention to it, the cumulative effect could be quite
Oh yeah.
vast and
Well, yeah.
damaging.
Yeah.
Uh,
Yeah.
but also the cumulative effect of even if you pay your taxes, it's time to get efficient with it, right?
Oh, for sure. Yeah. Like it
Yeah,
is, and again, we don't want, and it's a hard thing to manage is we don't want people on both ends of the spectrum, right? We really want people to take a balanced view to these things, right? Um, because bringing a really negative view around taxes and the rest of it, just as just a different side of the coin, right? And
yeah,
and really there's a reason why we started off the book around mindset and and really just how you're going to approach this problem, right? This issue,
yeah,
right? Is really just to say, okay, this is the environment. What can I do, right?
exactly.
But the cumulative effect is huge, right? Like for most people, this is the biggest expense you will ever incur.
And that would probably be true even if you're making 2 million a year, 3 million a year.
Mm-hmm. Mm-hmm.
It is still your biggest expense, right? So
Mm-hmm. Mm-hmm.
whether you're making, I guess, 60, 70, 80,000 a year or two
Mm-hmm.
million a year,
Mm-hmm.
it's got to be top of mind, right?
Yep. Yep. Yeah.
Yeah,
The people that are kind of in the the high rent district on taxes tend to have a lot of professionals around them. Uh,
yeah,
and, and, and,
naturally.
and, and I guess, a blind spot for people are that there aren't people out there that can help you, and that's just not true. Uh, there are lots of people that can help you. You just need to go out and find them. It's like, it's finding the doctor that's right for you. It's like, finding the mechanic that's right for you. I don't know if that's so relevant anymore with how they use computers and the rest of it, but the point is still the same: is finding that person that understands your situation and really relying on those human factors where you you just have a conversation and and the people that understand you will get the right vibes if you keep asking questions, right? They'll be patient, they'll relate to your situation, they'll ask you questions about your situation, they'll understand your situation, right? And then you'll know when you've got the right person in front of you. And I guess we're just saying to people, just don't be afraid to go out there and do what you can to improve your situation, right?
Yeah, don't be afraid to ask questions. Yeah,
Yep.
I
Yep.
think a lot of us are sometimes. We don't want to look stupid or
Yep.
that we're not in the know, but you
Yep.
know, everybody has to learn somewhere.
Yep.
Yeah,
Yep. Yep. For sure.
yeah,
Okay,
great.
Eric. Well,
I think that's awesome. Thank you
yeah.
very much.
Yeah. Great
I
day
think that
today.
was
Yeah.
helpful to
Yeah.
know.
Great
Yeah,
to spend some time with you. And yeah, we're getting to some of the meatier parts of the book. So today we talked about lots of things, right? We talked about taxes, how they're your greatest expense, how many taxes that there are. For the most part, a lot of it is kind of hidden from sight. Um,
Yeah,
for good reasons and maybe not so good reasons. I think, honestly, if it wasn't hidden from sight, it might impact people more than it does,
I
right?
think
So,
so.
that's another
Totally.
thing to think about, right? Talked about really to get some context of, how impactful taxes are. We kind of went through an exercise that showed some compounding and what various rates of taxes would have. Talked a little bit about, some issues around, estate taxation and some various components in estate taxation and TFSAs and RSPs and registered plans and yeah, and just how you can move forward, right? Like recognize where you are on the cash flow quadrant, um, and try and move towards your quadrants. Or if you're an employee, or move towards an investor. If you're self-employed, maybe move towards becoming more of a business owner. Yeah, and there's lots of work to do, and there's lots of good stuff, and it's like anything, and enjoy the work, right? Enjoy the journey.
Yeah. A lot of potential to save on taxes, I believe.
Yeah,
I'm sure you do too. Yeah.
yeah. All right.
Yeah.
Well, next episode we're going to talk about financing.
Sounds great. Look forward to it.
Okay, Eric. Thanks for your time
Thanks, Mike.
today.
Have an awesome day.
Okay.
Talk to you soon.
Bye now.